Hey guys, what's up? This is Akanksha and welcome back to my YouTube channel. In this video and in my upcoming videos, I will be talking about many aspects of technical analysis like candlestick charts, trend lines, support and resistance, moving averages, and different indicators and oscillators. I understand that there are so many people more knowledgeable and experienced than me to talk about this topic, but in this video and in my channel, I'm only going to share the knowledge that I have gained and the things that helped me during my trading journey till now. This is going to be a beginners friendly video, so I really hope you find this video helpful. Let's jump straight into it. Any beginner who wants to get into stock market or who just started trading must have a question. Is there a guaranteed way to make profit and avoid losses at any given time? Unfortunately, those who became trader find out that losses are inevitable, especially at the early stages of trading. It isn't possible to guess exactly the way the market is going to behave and how the prices are going to change. But technical analysis is a great tool that helps you improve the analysis of how the prices will look in the future, when to book the profit, and if it doesn't work, then when and how to quickly cut your losses. Now the question is, how does technical analysis work? If you have taken any level of economics class in your school, then you must have heard of these two words, supply and demand. Technical analysis is based on supply and demand. Technical analysis is a tool for getting clues into the future market movements of prices, as well as determining the most optimal time to buy and sell so that you can profit the most. Technical analysis is based on visualization and formation analysis and market dynamics. Visualization and formation analysis focuses on visualization of prices through line charts, bar charts, candlestick charts, point and figures, and so on, then interpreting chart patterns and formations. On the other hand, market dynamics looks into the strength of trends in the market. To visualize the strength of a specific trend, we look at indicators which also look into possible trend breaks and the overall direction of the trend. Beside indicators, there are relative indicators which recognize situations like overbuying and overselling. Using this, you can make smarter decisions to maximize your profit and cut your losses. Now you must be wondering, is technical analysis useful? So whenever we try to prepare for any school exam or try to acquire more knowledge about any subject, then we study what was written down beforehand, and technical analysis plays by the same rule. With technical analysis, we study what has happened in the market earlier to better understand what it could be like in the future. And once you do that, you won't be as surprised compared to those who have done no analysis and are entering and exiting the trades blindly. Now, where would you do the technical analysis? Enter charts. Charts give you the visual understanding of price movement of any asset. There are different types of charts. First is line charts. It is the visualization of closing or the last price traded over a given period of time. Second is bar chart. It shows how the stock have been traded over a certain period of time by displaying the opening, high, low, and closing prices of any stock. Third is candlestick chart. This chart shows the same information that a bar chart does, that is open, low, high, and close point of any stock in a selected time frame, but in a different way. A green candle says that the price went higher after opening, or the closing price is higher than the opening price. And the red candle shows that the price went lower after opening, or the closing price is lower than the open price. Another aspect of trading analysis is trend. Trends that exist in the market are uptrend, downtrend, or the market could be in consolidation state. And each type of trends has its own impact on traders' journey and their success in the market. Uptrend market can be identified when the candlestick chart is consistently making series of higher highs and higher lows. As the uptrend is occurring, price from the previous period that were seen as high are even higher than they were before. Not only do the highs finish higher, but the lows from the past period of time increases in value and end up being higher than before. This tells the trader that prices are rising and the overall value of the asset is increasing. It is very easy to recognize the trend if the prices are moving up and down like this. But what if the prices moves like this? It gets little harder. Having said that, I will show you how you can identify the trend in this scenario. Here you can see that the impulsive up move is followed by the pullback, and pullback is followed by impulsive up moves. The second high is above than the first high, and this low is above the previous low. That means even if the sellers are pulling back the prices, but there are more buyers that are controlling the market, and so the trend moves up. Now let's look at the downtrend. Downtrend market can be easily identified if the candlestick charts are consistently making series of lower lows and lower highs. During the downtrend, prices that were higher in value decreases the following period, showing the lower high concept. In comparison to higher prices finishing lower, lower prices change negatively and become even lower in the next period of time on the market. Traders can take away from this that the overall value of the asset is decreasing. It is very easy to recognize if the prices are moving like this. But what if the prices are moving like this? Here you can see that impulsive down move is followed by pullback, and pullback are followed by impulsive down moves. The second high is below the first high, and this low is below the previous low. That means even if the buyers are trying to pull the price up, there are more sellers that are controlling the market, and so the trend moves down. So the takeaway is higher highs and higher lows indicate that uptrend is occurring with the overall increase in the value of the asset. On the other hand, lower highs and lower lows can be seen in the downtrend, and it shows a decrease in the value of the asset. So traders can analyze all these information to make future decisions and predict potential changes in the market and in trends. And they can use that to make and implement their effective enter and exit strategies. So that was my video, guys. Thank you so much for watching this video. If you like this video, then please give it a big thumbs up. If you have any question, then please write in the comment section below. I will try to answer those to the best of my knowledge. And thank you so much for watching this video, guys. Bye-bye.